Most people think investing is a game of finding some magical secret. It usually is not. Most of the time, it is a game of small edges multiplied by time. That is why this conversation matters, because if you can do just a little bit better than the broad market for a long enough period, the difference is not small. It becomes huge. People hear that and immediately become stupid. They think I must be talking about doubling your money every year, or finding the next tiny stock no one has heard of, or turning yourself into a day trader with insomnia and a caffeine problem. I am talking about something much simpler. What happens if you get 1, 2, or 3 percentage points more than the broad market over a very long period of time? That is where the compounding starts becoming unfair. That is what the source text was really trying to say. And I think it is a very good instinct. As long as we clean up the exaggeration around it, the SP 500 is still one of the greatest wealth building tools ever created. I do not want that to get lost. The broad U.S. market remains an extraordinary default because it is simple, liquid, diversified enough for most people, and incredibly hard for the average investor to beat after taxes, fees, and emotional mistakes. That is still true. But it is also true that there are narrower baskets that have outperformed over long stretches. That is also true. The important thing is understanding what you are actually giving up in exchange for that chance, because you never get higher expected returns for free. You usually get them by accepting more concentration, more volatility, more sector risk, more factor risk, or some combination of all of them. That is the trade. And if you do not understand the trade, then the outperformance story becomes dangerous. So let us start with a broad benchmark. The SP 500 is not a perfect mirror of the economy, but it is still the most important core benchmark in U.S. equity investing. State Street SPY fact sheet for the 31st of March 2026 shows a 10-year annualized return of about 13.78% at NAV. That is already a tremendous compounding engine. And it is one reason I laugh when people speak about the SP 500 as if it were somehow mediocre, Faysight, Fayturn, 873,599, search 0 Fay. That is the baseline. 13 to 14% annualized for a decade is not boring in any serious financial sense. But now ask the real question. What if you own something a little narrower, a little hotter, a little more concentrated, and it does somewhat better? This is where the difference starts becoming financially meaningful. Let us begin with VUG. Vanguard Growth ETF is not some speculative toy. It is still a broad, large cap vehicle. But instead of owning the whole large cap blend universe, it tilts specifically toward the growth side of large cap U.S. equities. Vanguard says it tracks the CRSP U.S. Large Cap Growth Index. And as of the 31st of March 2026, it showed a 10-year annualized return of 16.13% at NAV. That is meaningfully above the broad SP 500 benchmark return over the same general period. Faysight Fayturn 133,376 view, 3 Fayturn 873,599 search. 0 Fay, now people hear that and think, great, problem solved. Because VUG is not a free upgrade, it is a style tilt. You are removing some of the value exposure and leaning harder into the part of the market that has been rewarded over the past cycle. That can work beautifully in the right environment. It can also hurt badly when leadership changes. That is the first lesson. Outperformance and concentration are often neighbors. The second example is XLK. This one is even more concentrated in what it is actually trying to do. State Street says XLK seeks to track the Technology Select Sector Index, which is effectively the technology slice of the SP 500. As of the 31st of March 2026, the fact sheet showed a 10-year annualized return of 20.91% at NAV. That is a gigantic number. It also means you are making a much more explicit bet on technology leadership continuing to matter. Faysight Fayturn 133,376 view 4 Fay. Now I understand why people love that. Technology has been one of the great wealth engines of the last generation. But when you buy XLK, you are not buying the entire productive breadth of America. You are buying a sector. More specifically, you are buying a sector that itself is top-heavy, The fund's own fact sheet shows the top holdings and sector composition are heavily dominated by semiconductors, software, hardware, and related tech infrastructure. That is why the returns have been so strong. It is also why the drawdowns can be much more violent than people emotionally expect when sentiment turns. Again, the point is not do not buy it. The point is know what it is. The third example is PPA, aerospace and defense. This is a very different kind of outperformance case. Invesco's fact sheet says PPA tracks the SPADE Defense Index, and as of the 31st of March, 2026, it showed a 10-year annualized return of 17.75% at NAV. That is higher than the broad market and came from a part of the economy people often ignore until geopolitics reminds them that defense spending does not really care whether your favorite economic narrative is elegant. FaceSite FATURN 266,174 search 1 Fay. This is what makes PPA interesting. It is not a simple growth story, it is a policy and priority story. Governments continue spending on defense through many market regimes because national security spending obeys a different emotional logic than ordinary consumer spending. That does not mean defense stocks only go up. Nothing only goes up. It does mean the economic driver can remain intact even when other parts of the market become shakier. And that is a useful kind of diversification if you understand the moral and political dimensions of owning it. You do not have to. You do have to think. Now let us look at SPMO. This one is where the language starts becoming more dangerous if you are not careful. Momentum works because stocks that have been strong often keep being strong for a while, especially when institutional flows and benchmark behavior reinforce leadership. Invesco says SPMO tracks the SP 500 Momentum Index, which selects from the SP 500 the stocks with the highest momentum scores and rebalances twice a year. The official Invesco materials also show that $10,000 invested 10 years earlier would have grown to about $49,020 by the 31st of March, 2026, versus about $37,594 for the SP 500 index. That implies a clear decade of outperformance, but it also tells you something important. This is a factor bet, not a core holding for emotionally fragile investors. FaceSite FATURN 266,174 search, 12 FATURN 493,852 search 8 Fay Momentum feels brilliant while it is working. It feels offensive while it is unwinding. That is the nature of the thing. So if someone wants to use SPMO as a sleeve inside a portfolio, fine. If they treat it like a magic machine that always converts past winners into future winners, they will eventually get their lesson. The fifth example is SMH, the semiconductor ETF. This is the clearest case of how sector concentration can create astonishing results when the world suddenly needs a lot more of one thing. VanEck's fact sheet for the 31st of March, 2026 shows SMH with a 10-year annualized return of 31.34% at NAV, 31%. That is not a typo. It is also the sort of number that makes amateurs reckless because they start telling themselves stories about inevitability. FaceSite FATURN 266,174 search 7. Face semiconductors have been one of the purest picks and shovels beneficiaries of the digital and AI age. Fine, but the same thing that gives SMH its explosive upside gives it brutal cyclicality. If you buy something like this, you must accept that you are not buying safety with a tiny upgrade attached. You are buying concentrated volatility with the hope of being paid for it. That is the correct way to frame it. Now, before I say anything else, let me talk about the bonus example because it matters. QQQ Invesco, S-owned QQ materials say the ETF delivered 19.43% NAV growth over the 10 years through the 31st of December 2025 versus 14.81% for the SP 500 over the same period. That is another good illustration of the same principle. Narrower, more growth, heavy, more tech-heavy exposure can absolutely outperform over long stretches. It can also make your life more emotionally difficult when the cycle turns. FaceSite FATURN 266,174 search 8 Fay, that is the thread connecting all of this. VUG, XLK, PPA, SMO, SMH, QQQ. These are not better because they are more intelligent in some abstract way. They are narrower, they are more exposed to whatever worked. They are more vulnerable if leadership changes. That is the price of the chance to beat the benchmark. Now, I think the most valuable part of the source text was not the list of tickers. It was the compounding math behind slightly better returns, because that math is real. If you invest $10,000 once and never add another dime, the difference between compounding at roughly 13.8% and compounding at 16%, 18%, or 20% for decades becomes very large. And if you keep adding money every month, the differences become much larger still. That is not theory. That is how compounding behaves. So yes, a modest edge sustained long enough changes lives. The danger comes when people stop asking the second question. What if the edge does not persist? That is the question that saves you from turning a good idea into a bad portfolio. Because past performance is not a promise. It is only evidence of what a certain exposure did under a certain regime, and the future does not owe us the same regime. This is why I think the right way to use these ETFs is not as replacements for judgment. They are tools. You can build around them, tilt toward them, blend them, size them according to your own risk tolerance. But if you simply chase whichever fund had the hottest decade and assume that is now your permanent strategy, then you are not really investing. You are buying yesterday's winner and praying that history becomes a service business. That is not a strong process. So how would I think about it? First, the SP 500 remains the base case, the benchmark, the ordinary person. As most useful default, I will not insult it just because narrower vehicles had a stronger decade. Second, if you want a chance to outperform, you should know exactly what kind of exposure you are adding: growth technology, defense momentum, semiconductors, NASDAQ concentration. Each one is a different bet. Third, the bigger the chance of outperformance, the greater the need for emotional discipline. This is the part too many people skip. It is easy to say you want XLK or SMH after a great decade. It is harder to hold them through the period when they go down much more violently than the SP 500. That is where your actual strategy gets tested. And the strategy I keep coming back to is one the source also emphasized, even if it said it in louder language than I would. Always be buying, not blindly. But consistently set the system, fund it on a schedule. Keep the cash reserve you need so you are not forced to sell at stupid times. And when real drawdowns happen in assets you genuinely believe in for the long term, buy more aggressively rather than less. That is the emotional edge most people never build. It is not that they do not know what to buy. It is that they cannot tolerate what ownership feels like when prices fall. This is where the distinction between owning a broad benchmark and owning a concentrated outperformer becomes enormous. The more concentrated your bet, the more you need to deserve it behaviorally. SMH is easy to love at 31% annualized over a decade. It is much harder to love when a deep cycle hits semis and everyone tells you the party is over. Momentum is easy to praise when the winners keep winning. It is much harder to hold when momentum rolls over and the factor suddenly looks stupid. That is why I say the real game is not finding one perfect ETF. It is building a strategy you can survive, if that means 80% broad market and 20% targeted tilts. Fine. If that means 60% broad market and a sleeve of technology, momentum, or semiconductors. Fine. If that means you stick with the SP 500 because you know your temperament cannot handle the narrower funds. That is also fine. There is no medal for owning a sharper tool you cannot emotionally hold. Now let me end where the source started. Slightly better returns matter a lot. More than people think, that part is true, but the way to pursue them is not with greed, it is with structure. Know what the fund owns, know why it outperformed, know what could reverse it, know how much pain you can actually tolerate. Then automate the buying and let time do the heavy lifting. That is how adults try to beat the market, not with fantasies of certainty, with measured exposure, durable behavior, and enough humility to know that every extra point of return usually comes attached to an extra point of pain somewhere else. That is the whole bargain. And once you understand the bargain, you can decide which version of it is actually worth accepting.